one stock that has been quite an outperformer within the large cap space. Reliance Industries has been proving its might. Yesterday, the stock wrapped up 2.3% higher at 2378. Is this an indication of a further breakout on the charts? Let's understand that better. Kunal joins in with the analysis. So, is it a yes or a no, Kunal?
Thank you, Aman, for that. I think it's an emphatic yes for Reliance Industries because this is more of a very coherent kind of an interesting indicator breakout. Now, this is the charts for Reliance Industries spanned over the last 12, 13 months approximately from 2022. Now, this is the indicator which is more important to map out for Reliance Industries. It's more known as a trend indicator. Now, every time a trend indicator gives a breakout, so for example, this was seen in June 2022 where the stock was almost at 2,500 levels. This was the point the breakout happened, and look at the start of a trend for the stock. This was almost like a 10% swing for Reliance Industries, where from 2500, 2550 mark, the stock went up to as much as 2800 levels. This was seen in July 2022 when the stock started to get into a consolidation, and then post that consolidation, confirmation of a breakout, we saw the stock moving towards levels of 2750 mark. Similar breakout was seen in the month of September, where the stock bottomed out. Look at this consolidation for the stock, and then post the breakout, the stock started to get into a trending phase, and in a matter of 1.5 odd months, the stock confirmed a 10% swing. Now, this is exactly very similar in terms of the price structure. So, as you can see, the previous instances, the stock goes into a correction, consolidates for almost 2 to 3 weeks, and then starts to get into a trending breakout. This is again a very similar kind of a breakout. Now, what's more interesting is the data for Reliance Industries on the futures front. Now, this yesterday's move is confirmed by the kind of sudden change in the open interest. So, as you can see, the last 5 days, there's hardly any change in the open interest for Reliance Industries, just about 2,500 contracts plus or minus for the stock. And yesterday's data indicates that there is almost a 16 lakh unwinding of contracts for Reliance Industries. So, that itself indicates that there was a major short covering which happened on the stock. Couple this up with the indicator breakout, this indicates that this could be a strong 10% up move over the next 2 to 3 months.
Okay, Kunal, I'll take it from there. Much like Reliance Industries, which Kunal believes is headed for a breakout, Niresh wanted to understand whether HDFC Bank could do the same.
So, HDFC Bank is something which one has to watch very, very closely, given that the stock is back to 1670 today. Now, when we look at a little longer term time frame, when the deal got announced, the merger got announced, the stock made a top of 1722. In the month of January, we made a top around 1700. Then we go back a little far in October 2021, we made a top around 1725. Then in January to February 2021, the stop was at 1640. Now, the 1650 to 1700 band has been a resistance, and over the last 3 months, we've been getting closer to it. So, if we break out above those 1700 mark, the last range for the stock is say from 1300 to 1700. A technical target price after that breakout implies a 400 plus pointer move. So that would imply a more than a 20% move over the next few months. So technically, this has become a stock which could become a leader in the Nifty. So out here, the view is to accumulate between 1600 to 1670. The last swing low for the stock is say 1570. That becomes a stop loss. Add on the way up about 1730 levels. And eventually, the stock could take leadership space and go towards 2000, 2200 in the medium term. So HDFC Bank could be the biggest surprise in the whole Nifty, apart from Reliance.
All right, those are some stocks to keep on our radar, but here are the stocks on the editor's radar. Let's talk about two result reactions and how brokerages and the street has reacted. We'll begin then with Siemens, which came out with its numbers. And much like a lot of the other capital goods counters as well, we have seen a marked improvement in their earnings. In particular, you've seen the margins as well scale up for smart mobility as well as for energy. And then the order book at close to 5,450 crore rupees, Nikunj, standing out at record order inflows.
No, they're in a good curve, so to speak. Aman. There is reason to believe that Siemens as a stock, even though the numbers just came during the market hour, I think they came post 3 o'clock. So the market reaction yesterday was hardly captured. I think large part of the market reaction post the numbers is due to be captured today. There are very few companies in the capital goods space also which are giving you this kind of an visibility and have that kind of an diversified order flow. The stock has done rather well for itself. It's an expensive stock, but not too many companies, Avan, in the market per se can give you such a solid growth even if valuation is expensive. So at a time in generally when there are few pockets of growth, markets will continue to price and continue to pay premium to a company like Siemens because the operating leverage benefit, and like you rightly said, that there are a lot of near-term catalysts in the smart mobility business, in the transmission business, which are at play right now. Capacity utilization for a lot of industry is not picked up. So I guess Siemens order book, Siemens business trajectory is here to stay. We are arguing about valuations, but given the current circumstances where a lot of other businesses are suffering, I think this is a stock which is expensive and will continue to remain expensive.
6% in the last one. Macquarie as well has raised their estimates on Siemens. So that's a stock to keep on your radar. The other one is Bharat Forge. Came out with its numbers yesterday and the stock duly reacted. Remember, you had the profits which slumped quite significantly on a year-on-year basis, and now brokerages are going ahead and going for a marginal EPS downgrade in the stock, and Nomura as well has reacted.
Yeah, the risk-reward ratio according to Nomura is not very favorable. I just want to break the entire business model of Bharat Forge just for the benefit of our viewers. And I'm just reading off the numbers from this Nomura report. Large 23% of the business is the global truck business. 20% of the business is essentially in the global industrial segment, and 10% of the business, that makes it about 50% of the total business. 10% of the business is in shale gas, and natural gas prices have come down. This 50% business is the traditional business which is slowing down. They've added new verticals to their business, largely in the business of defense, but that's work in progress. So the traditional business is slowing down. The new business is yet to catch up. So Bharat Forge is going through this transition, and the transition could take a couple of quarters before the real growth actually makes a comeback. If your main business, Avan, is slowing down, the new business, which is small business, will take time before it gets incubated. The good bit is that that business is growing, but it will take some time before it is able to really recoup or benefit the loss in the old business, which means in the short term, I expect Bharat Forge not to fall too much because the defense business is back on track, but it is unlikely to be a ranked outperformer. So if you don't own the stock, you may give the stock a skip simply because the risk reward ratio in the near term is not favorable. If you own Siemens, in that same breath, you should not sell Siemens, because even if the risk reward ratio is not that favorable because of valuation, the compulsions of this high growth business will continue to drive the stock higher.
Okay, so can give Bharat Forge a skip maybe if you don't own it, and Siemens continue to hold on. So Aisha, those are the stocks on the editor's radar.
Well, yeah, a couple of stocks there, really. Everything from a Siemens to Bharat Forge, that's in focus. But what about banks? Here's Dipan Mehta telling us what he sees in the near term for banks.
The merger, I think, has been in the works, but it's just getting delayed. But there's no denying the fact that the underlying fundamentals of IDFC First Bank have significantly improved. Do a quick comparison, I think it is a winner on all fronts, whether it is deposit growth rate, CASA, net interest margin, profit growth, improvement in the balance sheet quality. I think across the board, when you compare IDFC First to its peer group, it's a clear winner. The stock is at a reasonable valuation, a very aggressive management. And I think that amongst the banking stocks, it is our top pick, usual disclosure that we and our clients are invested, and should clearly outperform the bank nifty and some of the other larger private sector banks, and maybe a few of the PSU banks as well. So that is one stock that we're very positive on.